Hey guys, Mike Bonfanti here with Bonfanti Investment Services, and today I want to talk to you about how to save for your children's or grandchildren's education. There's a bunch of options out there, so what I'll do over the next couple of minutes is give you the pros and cons on the ones that seem to come up most in conversations. Let's start with the 529 plan, specifically the Louisiana START Savings Plan. If you or the future student doesn't live in Louisiana when the account's established, then it isn't an option for you, but I'm going to make a bold statement here. If you do live in Louisiana and have a 529 plan that isn't this one, you may want to reconsider the loyalties of the advisor who sold it to you. You have to go directly through the state to access this plan, so I'll link their website in the notes. If you do live here and have another state's plan, there are ways to move that into the START program and maximize some of the benefits. What makes the Louisiana START program such a good deal is the incentives they provide for Louisiana residents to use their program. First, there's an earnings enhancement based on your income anywhere from 2 to 14%, which essentially works like a match from the state similar to the 401k. Also, you can receive up to $2,400 in state tax deductions per child per parent. So a married couple with 2 children could receive almost $10,000 in tax deductions in 1 year. The plan uses a lineup of low-cost index mutual funds with no fees charged by the plan itself. There's a very high limit for how much money you can put into your plan, and the only catch is really that the money has to be used for qualified higher education expenses at an eligible institution. To simplify, that just means just about any accredited college or university. You can change the beneficiary from one family member to another, but if you don't use the money for qualified education expenses, you will pay taxes on the growth in the account and potentially a 10% penalty as well, and you'll lose any matches that you've received. The Coverdell Education Savings Account is the next option. Similar to the 529, the Coverdell allows you to use the money tax-free for education expenses. However, the main advantage of the Coverdell versus the 529 plan is that you can use the Coverdell money for elementary and secondary education expenses as well as college. In addition, you have added flexibility in choosing the investments within your plan, unlike a 529 plan that usually has a set fund lineup. However, that's basically where the advantages tend to end. The annual limit for contributions is only $2,000. You don't get a match, and you won't receive any tax deduction for your contributions. Also, if you make too much money, you'll be ineligible to contribute. Now, you may be able to get around that by gifting money to someone else first and then have them contribute it for you, but that basically just complicates things. The life of the Coverdell ends when the beneficiary turns 30, but some custodians allow you to change the beneficiary to another family member. But if you don't use the money for qualified education expenses, you'll pay taxes on the growth in the account and potentially a 10% penalty as well. So ultimately, the Coverdell works best if you're considering a private school for middle or high school. Next up is UTMA accounts, or UTMA accounts, which stands for Uniform Transfer to Minors Act. Basically, you're gifting money to the child who at the age of 18 in Louisiana can now choose to spend the money on anything they like. Let's just say this wouldn't have been a good option for me in my freshman year of college. The donor, parents or grandparents, can act as what's called the responsible individual and manage the money for the child until they reach age 18. There's a schedule, but for today, let's just say there are some tax advantages up to $2,100 of interest, dividends, and capital gains per year that the account makes. The good news is you can use the money in almost any way that benefits the child. If you want to buy a computer that really doesn't have much to do with school, just save the receipt, put it in the file you're keeping for the account. There are no penalties with regards to taxation for pulling the money out. A few things to be cautious about though. If you are considering using money for an expense that may not be in the child's name, like a car, that seems like a gray area that you may want to discuss with somebody first. Also, unlike a 529 or a Coverdell, you can't even it up, so to speak, by transferring money from kid A to kid B, because that's not really benefiting kid A in any way. These also have a negative impact on the child's ability to receive financial aid, since the assets are in the child's name and have a higher weighting in the calculations for federal aid. Finally, an option I often recommend is just save money in a regular brokerage account in your name. Yes, this is taxable to you, but you also have complete control over the situation. Unlike 529s, which have to be used for college, or Coverdells, which have to be used for school, or UTMAs, which are a completed gift to a minor, keeping an account in your name is also a viable option. The best part is, if your kid gets a scholarship, decides not to go to college, or isn't mature enough to handle the money, you can always use the money to buy a boat or make extra contributions to your own retirement, Or maybe you can be really generous and help them with a down payment on a house whenever they graduate. Since I've already run over on time, I'll just make a brief comment on life insurance. Please don't use life insurance as a college savings vehicle. I'm not going to go into this and may need to make this a topic for a future video, but I'll leave it at I've never seen it work better than what your other options are. As with anything, there are plenty of options to choose from, and each of them has their own set of rules to consider that I can't cover in such a short video. But if you have questions or want more information on how to save for your kids or grandkids' education, please find me at bonfiniinvestments.com, and I'm happy to send out more detailed information. And as always, go Tigers!